This is Nightly Business Report with Sue Herrera and Bill Griffin.
Bounce back. Stocks climb after yesterday's fall, but the self-imposed December 15 tariff deadline could prove to be a pivot point for the market.
Challenges ahead. A new report says the coming year could be very hard on housing for both buyers and sellers.
Retail experiment. Wait until you see the lengths that one retailer is going to just to sell coats. Those stories and much more tonight on Nightly Business Report for Wednesday, December 4th.
Good evening, everyone, and welcome. Another day, another trade headline, and another move in the market. Today, the direction was higher on a report that the U.S. and China are edging closer to a deal. As you know, the opposite happened yesterday. And as one trader put it, the market is like Pavlov's dog. Every time someone says trade deal, the market goes up or it goes down. Today, the Dow Jones Industrial Average was up 146 points to 27,649. The Nasdaq added 46, and the S&P 500 rose 19. But investor attention is now turning to December 15th. That's the day the U.S. is set to impose fresh duties on Chinese goods. Bob Pisani lays out three scenarios for the market as we approach that key date.
Stock staged a swift comeback from yesterday's losses. The Dow, the S&P 500, NASDAQ all snapping three-day losing streaks. Once again, trade sentiment continues to fuel the market's big moves as it has all year long. We're now less than 2 weeks away from the self-imposed deadline of December 15th for additional tariffs, and traders have been racking their brains over all the possible scenarios. So how would the markets react if, say, there's no trade deal and existing tariffs just stay in place, but we don't have any new tariffs going into effect on December 15th. Let's call that scenario A, and that's one most market watchers are expecting and hoping for. UBS floor director Art Cashin said that wouldn't spur big moves one way or another as long as investors get the sense that trade deals don't completely fall apart. But what if things worsen a bit and the president slaps even more tariffs on the Chinese in the next couple of weeks? Cashin said it will depend. If Trump puts on additional tariffs and bumps them up by 15%, which is what people might expect, a sell-off will happen, but not too severe. But what if we get tariffs that are 50% or higher? Cashin said, put on your helmet. Some market bulls are holding out hopes that perhaps Chinese officials will extend an olive branch, maybe invite U.S. negotiators to Beijing, or the president of China and President Trump will talk just before Christmas and perhaps agree on a truce. Bottom line, it's getting harder for the bulls to control this narrative, and the bar appears to be getting set lower and lower as hopes for a trade deal ebb and flow with each new headline. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now, while investors are focused on December 15th, officials in Beijing are watching lawmakers in Washington, and their actions could play a role in future trade negotiations. Eunice Yoon takes a look at the political tit-for-tat from Beijing.
Beijing is slamming the U.S. for criticizing the way China treats its local Muslim population. The House of Representatives passed a bill on Tuesday which calls for the closure of what the U.S. describes as camps, where millions of China's Muslim minority, the Uyghurs, are allegedly detained. The bill also says that Chinese officials involved should be sanctioned. China says the areas are voluntary training centers, and today the Foreign Ministry defended the policies, saying they are a necessary part of the country's anti-terrorism campaign. The ministry added that China would respond further if necessary, which could include blacklisting U.S. companies, based on remarks yesterday in the state press. The Communist Party paper, The Global Times, had hinted that Beijing is speeding up the publication of its so-called unreliable entities list. Up until now, officially or in state media, Beijing hasn't linked human rights issues such as Hong Kong or the Uyghurs to the trade talks, but today the foreign ministry came close, saying the bill will affect cooperation between the two countries in important areas. The ministry also reacted to President Trump's comments, suggesting there could be a delay on a trade deal past the 2020 election. The ministry said Beijing wouldn't set a timeline or deadline. Bloomberg is quoting sources as saying that the U.S. and China are moving closer to agreeing on the amount of tariffs that would be rolled back in a Phase 1 deal. From sources here, the Chinese had thought that they had an agreement on a tariff rollback almost a month ago, but then President Trump backed away from it. So it's unclear how close the two sides truly are. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Oil prices got a lift today on a large drop in crude inventories. This comes one day before a meeting of OPEC members, where the cartel is widely expected to extend production curbs. The price of domestic crude settled 4% higher to above $58 a barrel.
Private sector job growth slowed in November. According to payroll processor ADP, companies only added 67,000 new jobs last month. That was far below the estimates of 150,000. It was the slowest pace of hiring since May, as a matter of fact. The weakest sectors included manufacturing, commodity producers, and retailers. Of course, the government releases its own monthly jobs report on Friday.
A new report from the Institute for Supply Management points to a slowdown in the services sector of the economy. Economists cite trade tensions and worker shortages, which may lead to more concerns over the economy's overall health. The non-manufacturing portion of the economy accounts for a very big part of economic activity, and it includes industries like healthcare, finance, agriculture, and construction.
Most economists do agree that tariffs and trade will have the biggest impact on economic growth next year. But as Steve Leisman reports, measuring that impact is tricky.
Wall Street forecasters are struggling, just like investors, to figure out the outlook for trade and its effects on growth next year. But in general, they say, prolonging the trade war and increasing tariffs has three effects. First, it increases downside risks. Second, it limits the potential upside for any kind of surprise. And third, it confirms their modest growth forecast for 2020. Some economists have baked in trade peace, and others just aren't buying it. Goldman Sachs, in a report in November, wrote, quote, "We expect the drag from the trade war to fade gradually, although much could still go wrong. We now expect a phase one agreement to be signed in coming weeks," end quote. But after the president said yesterday there may not be a trade deal until after the 2020 elections, Mike Feroli at J.P. Morgan said, quote, "We never swung all the way to thinking that trade peace was breaking out, so it's not like we have to do a big pivot here." Goldman has a more upbeat 2020 outlook at 2.3%. J.P. Morgan not banking on trade peace, only at 1.5%. UBS, most pessimistic of all, at just above 1%. We contacted a half dozen economists after the president's comments. Most have just about had it with taking out the erasers. On average, they see the fourth quarter of this year and the first quarter of next as the bottom of the slowdown. Growth is seen gradually ramping up to 2% by the end of next year. In general, economists are inclined to assume the worst on trade and be pleasantly surprised if they're wrong. For Nightly Business Report, I'm Steve Leisman.
And then there's housing, a pillar of the economy and probably your most valuable asset. A new report tonight paints an unexpectedly harsh picture for the market next year. And it got the attention of prospective buyers, sellers, homeowners, and investors. Here's Diana Olick.
Almost everything is in place for a strong start to the 2020 housing market. Growing demand, a stable job market, and low mortgage rates. But one critical thing is missing: enough homes for sale.
We're running out of product to sell, so if you can't sell it, obviously, even with demand, prices don't have anywhere to go.
Realtor.com is forecasting a slowdown for housing next year and a potential record low supply of available homes. Low inventory will cause sales to drop just under 2% from this year, and home prices will flatten nationally, as millennials, who will account for half the buying market, struggle to afford overheated prices.
What do they find in terms of product? They have all upper end for new products, so the only existing inventory that they can really enter at is the existing home sales pipeline. And they're basically running out of products.
In some major markets, Realtor.com is predicting prices could go negative, the first time that's happened since the housing crash. Those cities include Chicago, Dallas, Las Vegas, Miami, Detroit, St. Louis, and San Francisco. With home values weakening, sellers will have little incentive to put their homes on the market because nobody wants to catch a falling knife. That will only weaken supplies further. Home construction is increasing, and the forecast is for a 6% annual gain. But so far, it has largely been on the upper end of the market, not at the entry level where demand is strongest.
The only good news in this report is that mortgage rates should remain low, but low rates will only help if consumer confidence in housing is high. For Nightly Business Report, I'm Diana Olick in Austin.
Time to take a look at some of today's upgrades and downgrades. We only have two for you tonight. First, Marvell Technology was downgraded to market perform from outperform at BMO Capital. The analyst says that the semiconductor maker stock is reasonably valued right now. Price target $28. That stock fell about 5% today to $23.92. And then Owens Corning was downgraded to neutral from buy at Bank of America Merrill Lynch. The analyst says that the long-rumored breakup of the fiberglass company is not likely in the near term. Price target $72. Shares fell a fraction today to $65.43.
Still ahead, United Airlines places a multi-billion-dollar jet order, and it's a blow to Boeing.
The White House is changing work requirements for some food stamp recipients. The new rules make it more difficult for states to waive a requirement that able-bodied adults without children work at least 20 hours a week or risk losing benefits. Critics say that could make hundreds of thousands ineligible for the program, but the administration says it will get more people into the workforce.
What we're doing, people have to work 20 hours a week or volunteer 20 hours a week or be in job training for 20 hours a week. What we want to do is increase employment. We need these people in the workforce.
The rules take effect in April of next year.
European plane maker Airbus announced a major order of its new long-range airplane. The buyer is United Airlines, which is purchasing 50 of the jets. It's an order Boeing could not compete with as it tackles a number of issues, including the grounding of the 737 MAX. Phil LeBeau has more.
United Airlines is turning to Airbus for its next generation of planes to fly between the east coast of the U.S. and destinations in Europe. The airline is buying 50 Airbus A321 XLR planes. First flight, 2024. United did not place an order for long-range planes with Boeing, in part because Boeing does not have a model that fits United's needs. Earlier this year, airline executives expected Boeing CEO Dennis Muilenburg to announce plans for a new long-range model. That never happened, due in part to the grounding of the 737 MAX, which has become the primary focus for the company. So airlines like American will fly the new Airbus plane between destinations that are further apart, like the U.S. to Europe, where U.S. carriers are battling foreign airlines who get higher marks in a new survey of travelers flying from North America to Europe and Asia. To Europe, those surveyed by J.D. Power ranked Turkish Airlines first, then Virgin Atlantic. British Airways and Delta tied for third. A big reason some airlines rank higher than others for international trips, what they serve passengers.
The food and beverage service is actually a little bit more important to the satisfaction. And that's really because food and beverage is an interaction between the airline and the staff that's in the aircraft itself.
Those flying to Asia put Japan Airlines at the top, followed by Delta, Korean Air, and the Japanese carrier ANA. J.D. Power says U.S. airlines are not far behind their foreign competitors when it comes to flights to Europe and Asia, and they could further improve as Delta, American, and United make further investments in their international routes. Phil LeBeau, Nightly Business Report, Chicago.
And we're learning that Boeing's chief engineer, who led Boeing's response to the crashes, is retiring.
Last night, we told you about the transition of power at Google parent company Alphabet. Google co-founders Sergey Brin and Larry Page are stepping back, and current Google CEO Sundar Pichai is also going to become the CEO of the parent company Alphabet. And as Deirdre Bosa reports now, the new boss faces a list of challenges.
It's the end of an era at one of tech's biggest and most successful companies. Google co-founders Larry Page and Sergey Brin are handing over the reins to engineer-turned-manager Sundar Pichai. Pichai has already been overseeing the company's core businesses as Google CEO, but now as Alphabet CEO, is he ready to take the company into the next decade, one that is fraught with more challenges and threats than ever? Regulatory battles in the U.S. and Europe are brewing. Employee activism is on the rise. and privacy practices are under fire. Now, Pichai is relatively untested when it comes to the type of battles other big tech CEOs like Facebook's Mark Zuckerberg and Apple's Tim Cook have been fighting. Another challenge for Pichai could be actual control. While he gets the full CEO title, Larry Page and Sergey Brin are still Alphabet's biggest individual shareholders. They still retain control through their majority voting power. Day to day, not a lot is changing at Alphabet. Pichai will continue to run Google's most important and profitable businesses, while now also overseeing its more ambitious moonshot projects. On the horizon, though, Pichai has his work cut out. For Nightly Business Report, Deirdre Boza, San Francisco.
Campbell's reports soupy sales, and that's where we begin tonight's market focus. Campbell's Soup sold fewer of its namesake products in the U.S. in the most recent quarter, but the company did see an increase in its share of the soup market for the first time in 10 quarters, and its earnings came in better than expected. That was enough to lift the stock, which rose about 2% to $48.47. It hit a 52-week high during the session. Expedia is replacing its CEO and CFO following a strategy disagreement with the board of directors. Earlier this year, Expedia sought to unite its brands, including Orbitz, Hotels.com, and VRBO, but the chairman of the board said the strategy failed and led to disappointing results. Expedia shares were up 6% to $105.56. Constellation Brands sold its Ballast Point craft beer unit to a small Illinois brewery for an undisclosed amount. Constellation bought Ballast Point in 2015 for a record $1 billion. This deal is believed to be below that amount as the market for craft beer has slowed. Shares were off a fraction today to $184.29.
G3 Apparel Group missed sales estimates for the third quarter, and they've lowered their guidance as a result. Company which owns brands like Donna Karan, Calvin Klein, and Tommy Hilfiger blamed the shortfall on trade tariffs. G3 fell 2% today to $27.89. Union Pacific said that it sees fourth quarter shipping volumes down a little more than 10%, and the rail operator also expects revenue to slip by about that same amount. But after falling for 5 straight sessions, the stock actually rose 2% today to $171.46. Instructure is being acquired by private equity firm Thoma Bravo. The price tag is about $2 billion or $47.60 a share. That's actually 10% below yesterday's closing price. Last month, the education software company said that it was reviewing some strategic options. Instructure dropped 8% today to $48.75.
Following YouTube's recent landmark $170 million settlement with regulators for alleged violation of children's privacy laws, the company is changing its policies and restricting some features around content aimed at kids. But that is not going over well with creators. Elon Mui has the story.
Jeremy Johnston normally fills his days with family.
All right, who wants to help me?
And plenty of fun.
1, 2, 3, go!
And he shares it all on his YouTube channel with his 2 million subscribers. It's his full-time job and a big business. It takes up to 40 people to put together all these videos. But lately, the most important place for Johnston to be is Washington, D.C.
We're trying to inform the FTC commissioners and legislators about how the regulation is going to impact creators who make family-friendly content.
Johnston is worried his channel and his ad revenue are about to take a big hit. That's because YouTube is changing the way it handles content aimed at kids. Personalized ads will be banned, and features like comments, suggested videos, and playlists will be turned off. It all comes after the company was forced to pay a record $136 million to the Federal Trade Commission over allegations that it illegally collected children's personal data. Privacy advocates say the change is long overdue.
I do understand that this is going to affect their bottom line, and they're upset about that. But I think one thing that they need to recognize is that the business model that they were using was an illegal one.
Some content creators predict their ad revenue could plunge by 60 to 90%. So now they're fighting back.
This is very serious.
So family-friendly content is kind of in danger right now.
We may not be able to create content on YouTube.
Creators argue that YouTube's new rules actually discourage them from making content for kids because they can't make any money doing it. Some of them could move to Amazon Prime or Netflix where the rules are different. But most of all, they just want Washington to hear their side.
As they're getting this new information, they're reconsidering, they're thinking about it, and they're realizing that this is a bigger problem and that they don't want those unintended consequences.
For Nightly Business Report, I'm Ilan Mui in Washington.
And coming up, we're going to take you to a store that has no inventory, but it does have a daily snow store. Here's what we're watching tomorrow. This is highly anticipated. Biogen is presenting data from its experimental Alzheimer's drug 6 weeks after the company said it was bringing that treatment back from the dead. That should be interesting. Members of OPEC meet to decide on production levels. Jobless claims, international trade, and factory orders are all on the economic calendar as well. And that's where we're watching tomorrow, Thursday.
Hedge fund manager Steve Cohen is in talks to increase his stake in the New York Mets. There are reports that Cohen could end up controlling 80% of the baseball team. Under the agreement, Fred Wilpon would remain CEO of the Mets for 5 years. In April, Forbes valued the New York Mets at $2.3 billion.
Finally tonight, as the retail industry evolves in this digital age, stores are popping up that have no merchandise for shoppers to take home. Canada Goose is the latest retailer to open a so-called experience store, one that it hopes will help consumers understand why Canada Goose outwear is worth the $1,000 price tag. Courtney Reagan went to Toronto to experience it for herself.
We're in a mall in Toronto, but this new Canada Goose store is not really a store at all, but an experience. We're going to take you inside. The entrance of the store is called the crevasse. It literally means deep crack in a glacier. As you walk, it sounds as if the glass is cracking under your feet. The walls are made to look and feel like rock, and you can hear above the soundtrack of the Arctic. Then you enter the elements room. It's surrounded by curved walls projecting nature films shot in British Columbia. Those films will change as the seasons change. In the middle of the room, mannequins, and the gear will complement the season. Now you're in the gear room. This is meant to be a reinterpretation of a seed vault, which is in Norway, storing the world's seeds in case of a pandemic. It's located in the permafrost. You're going to get a brief explanation of the merchandise, and you're going to choose the gear that's most appropriate for you and how you deal with cold, and then you're going to take it inside the cold room.
Stop for you.
Now you're in the cold room. This is about 10 degrees Fahrenheit, but can get as low as -4 degrees. It's meant to simulate Arctic conditions. Well, Canada Goose does have other cold rooms. This is the only one that has actual snow.
What's really important is the experience and to be experimental and to try new things, especially in this day and age where, as we all know, retail is changing.
If the Canada Goose Journey store did its job, you'll actually leave empty-handed. There's no inventory here, but you can come to one of these kiosks, pick out the item that you like, and it can be delivered to your home the same day or the next day if you live right here in the Toronto area. The no inventory store is part of Canada Goose's growing direct-to-consumer business, which makes up about 1/4 of total sales. But the new experience may not be enough to convince investors that have given the stock the cold shoulder. Shares are down 45% from all-time highs set last November and down more than 10% so far this year. For Nightly Business Report, I'm Courtney Reagan in Toronto, Canada.
That is very cool.
Yep.
Literally.
Literally, yeah.
That is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. We'd like to remind you that this is the time of year your public television station seeks your support.
I'm Bill Griffith. Thank you for that support. Have a great evening. We'll see you tomorrow.